grow. One is we have the opportunity to grow. Second is I think we have a clean balance sheet, both corporate and banks. And I can say this that in my 50 years of banking, I have not seen a cleaner balance sheet over this course. So the bank balance sheets are clean. Corporate India, throughout my career, I saw corporate India, leverage of 4:1, 2:1 long-term debt to equity, and another you add on working capital debt 4:1 till 2000. Post 2000, it came down to maybe 2.5:1 total debt to equity. Thereafter, it has dropped. And today, if you look at the top 100 companies, hardly any debt, including working capital debt. There's hardly any debt. So you have, I would say, the conditions, the ground conditions for growth intact. And what we typically probably do not as yet fully reckon and will reckon is the impact the digital super cycle will have on India. Again, I use China as a proxy. 30-35% of the economy today is driven by the digital economy there, and we have all the makings of it. And we have one significant advantage because a lot of technologies we have leapfrogged, whether it is artificial intelligence, machine learning, or go back to the whole digital world, we have leapfrogged. As indeed we have leapfrogged in terms of clean energy. What I mean is the cost per installed unit has been significantly low because we were late starters, as we were in telecom. But then, of course, we have set our own benchmarks. So I'm sure that given this playing field, clean balance sheets, clean banking balance sheets, we are set to grow.
You don't seem to believe that we were a little behind the curve in terms of interest rate hikes when inflation hit us, and also now over time the rate of hikes of interest rates has also come down. The last CPI print is also looking good. Where do you see? Do you think we are at the end of the rate increase cycle?
Yeah, I think throughout my career I have never tried to comment on central bank policy. I'll just make this point that the events in the West, whereby they believe it is now right to be behind inflation, after preaching to us all these years, when we were struggling to manage it, and we ended up increasing interest rates and maybe hurting ourselves. I don't know. In retrospect, somebody will have to analyze. I think what we did this time was right. Perfect. I would think to great confidence on the part of the monetary policy authorities to do that, and government to support this policy and hold the thing together, because indeed by being behind the curve we could have damaged ourselves. But I think new economic theory is being written where inflation and interest rates don't necessarily go in hand to hand, and we will need to examine what are the controls and checks and balances of inflation distinct from interest rates as we go along.
And the interest rates are now sort of easing out, the rate hikes.
Yeah, indeed, I think there is no need to do any trade-off at all. I would think that if we had not done this, we would not have had as clean balance sheets as we have today. Just to put it in context, the expectation was when COVID hit us that the book that would come for restructuring, you remember there was the expert committee to restructure. Our estimate was that around 9 lakh crores of assets will come for restructuring from corporate India. In the event, 1 year later, all that came up was 45,000 crores for restructuring. And I can equally certainly say that if interest rates had not been held where they had been held, and of course, the containment measures COVID taken by the country had not been effective, we would not have been in this situation. But a good part of it was because interest rates were held.
You have been in China, Mr. Kamath. You just spoke of China earlier. Also, we were having a discussion on that. What do you see the threat which China can have on the Indian financial stability, if at all? And what is the kind of what can be the challenge which the Indian financial system will face?
No, I don't see a threat per se from China in terms of the financial system. A threat in a competitive context should have been to our manufacturing, but there again I think policies that are appropriate have been taken by the government. We allow, I think, imports of things that this country needs, and generally, yes, there is a trade balance which is in favor of China. But I think we have been managing our overall global trade balance in a way that it should not impact us. But the financial system per se, I don't see a threat.
And in terms of the global uncertainties, at this point, where you say that they are on the decline, what is the kind of challenges which the Indian financial system needs to prepare for going forward in a completely different globalized world?
Well, I would think the key learnings of, let me start with the events in Europe. To me, the key learnings there are several. One important one is that the fear of sanctions could also then be turned to advantage. For example, Russia, when sanctions were imposed, I think the financial world expected it to collapse and disintegrate in terms of its financial structure. That did not happen. So you had a quick peg moving on to the gold standard, as it were, to say that link the ruble to gold and pay me in ruble, and then the currency which had gone from 60 to 140 corrected back to 60. So there are quick learnings that are coming out in terms of what could be action and what could be consequence. And I think all countries are watching this. The second consequence was really payment systems, the hegemony of one payment system. I think you can see now what is happening in terms of, I would say, the rest of the world coming together to say that we need to work on parallel payment systems. And in India, I won't talk of other countries, I think we have done virtually revolutionary stuff with the UPI. And that becomes the backbone of the payment and settlement structure in the country, with all the checks and balances that any Western system has. And if we can take that as the settlement system that we want to use globally, which indeed I saw a notification just yesterday, taking one step forward in that direction. But if these are used as a path that we would adopt to deal, we are de-risking ourselves considerably. Somebody forwarded me a piece today that the second largest Russian bank has set up a settlement route in rupee. I'm reasonably sure that this is going to happen more and more on a bilateral basis, and there will be newer systems coming up to, in a way, supplement older ones. And not necessarily that older ones have to be completely disbanded. But we are entering very exciting territory, all driven by technology and all driven by our country's ability to leverage technology. The two things are coming together to provide us a safety net, which just 5 years back just wasn't there.
You've been a firm believer, Mr. Kamath, of India's advantage in creating this digital super cycle, and therefore that being a major engine in powering growth in the next, say, 10, 12, 15 years. Tell us a little more about what are the key changes you see happening.
Yeah, but I'll actually lay the foundation as to why this is happening and why I believe happening. I think it all is on the foundation of affordability. You have affordable device cost, you have affordable data cost. Given that, I think it is as easy for somebody in a remote place, not really seeing what is happening in say, urban India or the rest of the world, to be digitally connected at within his capability, I would say, to connect and be a part of that process. So all you have to do is to look at this new India. I get fascinated by what I call YouTube content creators. And I'm not meaning influencers. I'm talking of small town content creators. I would urge people to spend a little time before you go to sleep trying to understand what's happening. And where is YouTube and the algorithm pushing you? It's pushing you to rural India. So you know that something is happening in rural India. The content creators in rural India have got more subscribers than content creators in urban India. Their content has more views on a daily basis than urban Indian content. And people who are coming from a village, no sewage, no water supply, plain brick walls, unlined, are today making over $1 million in terms of income streams from creating 10-minute content every day, and being seen by maybe 6 to 7 million people on a daily basis. So I could not have imagined this 5 years back, that we would have an India where somebody coming from a village would create this sort of a following. I salute these sort of trends. And this is not unique. This is spreading across, because what this person is doing and people like him are doing is being followed by his subscribers and the viewers, and their aspirations increase and so on. So it is not just the digital connectivity we see in the urban case, where we use UPI or something subtle, but at the very deep end, a change is happening, and the change is also bringing in income. So I think a confluence of this, and of course you then have the digital startups, which are all a given, so I'm not going to talk about that. So they propel the whole digital economy forward, and of course there will be churn, because some of these startups will try to determine their place in the marketplace, as it were. I think they all created very valuable platform. They now have to determine their value in the marketplace. And I think there is some learning curve going on there. But as this goes along, the whole momentum is not going to slow down.
Earlier in the day, Mr. Kamath, we had discussions around banking and digital in the digital age. And one of the banks, a smaller bank, actually came up with the contention that as banks go digital more and more, they will bridge the gap between bigger and smaller banks, and they will come closer to the customer, sitting side by side with the bigger ones. Now, what does that mean for the bigger players? I mean, you've been chairman of CEO of ICICI Bank. What does it mean for banks like your earlier bank and the other big ones?
Yeah, again, it's a very interesting observation, and I entirely agree that's going to happen. Though I think it's going to happen in a slightly different way. It's going to happen because of this new digital world. Those are the players who are bridging, and they're bringing the smaller bank to the bigger bank, because what say a large number of incumbents can't do is use technology appropriately. They may think that they are using technology appropriately, but they aren't, because legacies are very difficult to overcome. And when we launched technology 25 years back in the bank, people would say that, how different are you from the West? And we are willing to take risks because we have no options. But over 25 years, every bank in India has gotten to be a legacy. So are you willing to jump ship? You aren't. So who is jumping ship? The new digital players are willing to jump ship. They are willing to put in a plug and make the small bank probably not as, more efficient than the big bank. So indeed you will see the customer. So if the customer were using, let us say, an app of a neobank, and compare that with an app of any incumbent bank, no two guesses which one is more superior. Superior, smarter, that's the neobank app. So clearly they are giving, I would think, a good path to the smaller banks to interface with the customer. Will they get to be as big as the large banks? I don't know to make that.
But the large banks are also getting smarter and creating
But it's a question of time. You talk to a large bank and ask him, how long will it take you to redo an app? The answer, this is the actual answer that I got, 2 years. You talk to this small guy and you say, how long will it take you to redo your app? 6 to 8 weeks. 6 to 8 weeks. That's the time difference. Where are you in 2 years and where are you in 8 weeks?
That's true. In the fintech world, Mr. Kamath, there's another school of thought which says it is not an either-or situation, banks or fintechs. It is an era of partnerships. I mean, that is how they will reach the last mile. That is how they will lead generation, is where fintechs will come in, and then the banks take over. How do you see this whole bank fintech play coming out?
But that's exactly what's happening. I entirely agree with that. If you see what I mentioned just now, the newer bank is just a front end provided by a fintech firm to an incumbent bank. Typically it has been a small bank which has leveraged this, but it could be a big bank tomorrow. So I think clearly that is a path to grow, where you have challenges with your legacy platform. You can work with a new platform. And I would think that in all these, the newer applications that will arise, the fintech firms will be more agile, and this partnership has to be leveraged for success.
On the NBFC front, as more and more newer NBFCs also come in, some of them backed by some very big groups, do you see this whole lines between bank, fintech and NBFC getting blurred, and NBFCs looking at merging, because that's something RBI has on its agenda, pushing bigger, larger NBFCs to actually turn into banks and merge with banks, as has been the RBI's view. How do you see that playing out?
I see this as an evolutionary path, because as of now there are probably only a couple, maybe 2 or 3 very large NBFCs which could provide this. But if I look at it in depth, yes, they are providing products in a much more agile and nimble way than what the banks are. And I think that is good. And the banks probably need to learn from these entities and see what they could do to compete on a like-to-like basis. Yes, as of now, funding cost for an NBFC is probably higher than that for a bank. And regulator, rightly so, would like to make sure that the oversight mechanism is as robust as it is for a bank. So I think this is a period of finding level. And once that level is done, I'm sure the regulator will put in place what is required, whether it is tighter oversight of NBFCs or the path that you said. Then, of course, the questions will arise, what sort of NBFCs will be allowed to convert to a bank and so on. But I would think in the next 2 years, 3 years, we should have clarity on this.
There is this whole debate now on the level of credit growth, the high credit growth, and the deposit growth not keeping pace with the credit growth. Now, how do you see that, and what that is a crisis which could be sort of staring the banking sector in the face? How do you see banks playing that out?
I don't think it's a crisis. I think it's just a question of analyzing facts. Historically, bank deposits and the banking sector in general have grown at around 1.3 to 1.5x of your GDP growth. So if you look at if 7 to 8% of the GDP growth, deposits I think currently are growing at around little over 10% or so. It's appropriate. I think what you see in terms of credit growth was probably what was not happening in the last 2 years. So your base was small. So you probably need to correct for base and say, I have not done it, but then you will get a better picture. A. B, yes, you should also factor in that there could be a shift from savings going into bank deposit to savings going into other means of savings, whether it is insurance or mutual funds. Because mutual funds are now growing at almost 50% higher rate than banks. So there is a shift away. But from there again, money is coming back into into the corporate world, either through equity or through debt instruments. So I think it's a positive cycle of growth with the money that is the saver wants to put in going into a few areas in terms of what.
So you don't see an asset liability mismatch?
I don't see an asset liability mismatch. And there would have been an asset liability mismatch if the banks continue to lend for infrastructure without having the right liability structure. But I think now the government, the central bank, and both the banks and the borrower have realized that that is a risk that we should not be carrying. And I think that correction will happen now. As, for example, corporate world, corporate borrowers, where they have long-dated instruments, the need for long-dated instruments, I'm sure they will approach the market. And newer structures are coming to play in the market, to be seen in the marketplace. Take, for example, the REITs that are there. I think we are at the start of, say, a whole set of new instruments, which will provide appropriate tenor support to you in the financial context and de-risk your operations. And banks, see, where are banks ideal? Banks are ideal where your maturity profile is 1 year on an average. And it's a very secure lending like home loans. The maturity may be longer, but then you have an option to reset. But if you were to do fixed rate home loans for a long maturity, then you're carrying an untenable risk in your books. So I think these learnings are coming up, and
in fact, that was to be my next question about, you as NABFID, now you're in the infrastructure space in a big way. And as the government pushes capital expenditure, infrastructure in a huge way, we have the entire government push behind it. What are the kinds of mistakes which, we saw what happened to banks which earlier when they went into infrastructure without doing exactly what you are suggesting that they should be doing and are doing now. What are the kind of key things, 3 or 4 things they should keep in mind so that mistakes aren't repeated?
I think there is a whole lot of systemic things that one needs to look at. I think one is, say, the financial context, whether the funding that you are doing is appropriate, the leverage and the tenor. Are you sure of that? Second is, are you sure of the cash flows from the underlying asset? And for that, do you have the adequate checks and balances and the evaluation mechanisms that are needed? And is there, I would say, history to tell you whether you will go wrong or right? Now, when we look back at probably 2010 onwards, lending that took place, there was no history. You really did not know what could go wrong in a power project. And a lot of power projects have gone wrong for, I would say, reasons much beyond that a bank could have handled or the entrepreneur could have handled. For example, you were given the license to mine coal and the license was withdrawn. I'm not going into why. What happens? Who takes the risk? The risk has been borne by but now, 5 or 7 years later or 10 years later, you know that that risk is present. So I will not venture unless there is a mine in production. So I am not going to go by, so you are better informed. Similarly on a road project, the issues and the challenges in acquisition of land. And for that, I think the government did a good thing to say that we will seed these.
Yes.
And we will, implementation risk is taken care of. And then to market, and I think the NHI model is a brilliant model, where they take care of the initial risk and market, and they could sell the asset in the market, create a REIT out of it, which is what they're doing now, and get appropriately funded. So these structures did not exist 10 years back. Now this is part of your learning. So I think the mistakes that first. We have our core models. My colleague database that has been created. So at every point, these learnings add to what you could do.
Mr. Kamath, we are at the threshold of the last full budget before election year. And we have, as we discussed, some headwinds. We have limited fiscal space. What would you think, what would you expect and hope from the upcoming budget this time?
I think, again, the government has done a remarkable job in tiding over the last 3 years, 2020, 21, 22. And I think those learnings are already there. And what I say is probably something which is a status quo, but driving more efficiency in the system. Because you see the impact of efficiency that has been brought in terms of government revenues, collections on whatever front and so on. So I think that is the mantra. Just keep pushing that to improve efficiency and improve government revenues, and the rest falls into place.
So you see a continuing push in government capital expenditure? Like
I would think so. I would think so. I don't see any reason why they should. And I think the emphasis will be on increasing revenue through better efficiency and collection. And that should then defray, whatever you need to.
Do you think the hope that private sector investments in expenditure, capital expenditure will follow is happening? Do you see those?
Yeah, my view is that, we were just discussing this before we came, and that corporate India has clearly learned that now you need to manage very little debt. From 4:1 debt equity in 2000 came down to 2:1 in 2010, and now virtually no debt at all on the books. I think corporate India is loving that situation. So I don't expect them to borrow, but they're also generating huge amounts of cash. So they are deploying that to grow in their existing businesses. But if you were to tell them, take that cash, leverage it and build a new business, they may not be willing to do that. So that, I think they are reassessing strategy, most of them. But what they are doing should be enough to provide us the sort of economic growth that we want, supplemented by infrastructure spend which the government is doing. And there is also large infrastructure spend happening from the private sector in areas where they believe de-risking has already been done. So if you look at ports, airports, power, green power particularly, telecommunications, it's only in those areas where there is still some perception of risk where government is spending.
Is not being deployed in new projects in some areas, but there is infrastructure spend which is happening from the private sector as well. Now, before we wind up, Mr. Kamath, you are now associated also with this big behemoth which is supposed to enter the financial sector, which is Jio Financial Services. Tell us a little more about how that is coming.
Well, I think what's available just now with all of us is just the
Mr. K.V. Kamath, thank you very much for speaking to us. It's an absolute pleasure.
Thank you so much, Mr. Kamath. Thank you, Saurav. I'd like to